Good afternoon, everyone. This is Marianella Collado. We will be starting in just a couple of minutes. We'll give everyone a little bit of time to join the call. And in the meantime, I want to confirm that Karen can hear us. Karen? Hello, just confirming that Karen is now able to join the discussion. Karen, can you hear me? Okay, we'll just make sure that we change her settings, so give us a few minutes.
Hello?
Hi, Karen. Okay, excellent. Okay, so
Here
we'll
we go.
just, Karen?
Yes, hello?
Excellent. Okay, thank you so much. I'm glad it worked. We just had to change your settings. So welcome to the call. So
Thank you.
this is Marianella Collado. I am the CEO of Tobias Financial Advisors, and welcome everyone to our first quarter market call. I am here with Matt Sainholtz, who's our Chief Investment Officer, and he's going to walk us through some exciting trends along with Karen's input. So we look forward to the discussion today.
Good afternoon, everybody.
So one of the things that we do want to make sure that we address before the call is we're covering some general information. And so if you have specific questions on your portfolios or things that you should be considering, we always recommend that you speak with your advisor about your specific situation. So again, if you have any questions with regards to how any of these points affect you, please be sure to give us a call after today's presentation.
Separately, on a housekeeping note, there should be a way on your webinar dashboard to submit questions, which we will be looking forward to addressing towards the end of our segment today. So feel free to ask us questions through the webinar feature.
So just a little bit about us for the benefit of those folks who may not know us or work with us today. We were founded in 1980. We currently manage over 375 million assets, and that includes individuals, trusts, partnerships, pension plans, and we work with our clients and their children. We really try to make this a family relationship because we truly believe in the concept of holistic planning, and that usually goes from generations to generations. Together, we have over 75 years of experience, and we do make sure that all of our advisors are CPAs or certified financial planners or chartered financial analysts. So we do believe in making sure that the team members that service our clients have the right credentials to be able to do that. And on the call today with us, we have Karen Umland, who's from Dimensional Fund Advisors. She's a senior portfolio manager and a member of the investment committee at Dimensional. She has been with Dimensional since 1993, and I'm excited to hear a lot of her insights during today's conversation. So if Karen, you want to just maybe say a little bit about yourself, and then we'll get into some meatier discussion as we move along.
Yes, absolutely. As you said, I've been with Dimensional Fund Advisors since 1993 in the portfolio management team that entire time with a focus on equities. Started out with the U.S. equity area and spent about 15, 16 years after that working on the developed market and emerging market portfolios, and now have more general oversight across the different global equity portfolios.
Excellent. So for clients here, you may have noticed that some of the holdings in your portfolio are Dimensional Fund Advisors Fund. So definitely, please make sure you ask any questions. This is your opportunity. We have them on the call with us, so feel free to ask any questions that you can think of. So, before we get into discussions on what happened this past quarter, what's the outlook for the future, we always try to set the stage and really educate our clients that our role as investment managers and planners is that we can only really try to control the things that we can control. So from our perspective, nobody can time the market and do it effectively, consistently, year in, year out. So our focus will always be, and we may sound like a broken record, but we truly do believe that the value in financial planning is controlling the things you can control, from minimizing taxes, reducing portfolio expense by reducing the turnover. So we constantly tell our clients, we're looking at where we are in the strategic allocation, and if we don't have to make a trade, we won't do it because we don't want to trade just for the sake of trading. It doesn't add any value to the portfolio if our allocation is in line with whatever return we need to help you meet your goals. And truly diversifying broadly, minimizing that risk to your portfolio by owning baskets of securities in each of the asset classes that are going to yield the result that you need in the long term. And we do this by structuring a portfolio around different dimensions of return. And this is where we have that tilt towards value, which we've discussed in the past. So again, we start with a plan, we talk about goals, and we have to really focus on that long game because in the end, no one can predict, what's going to happen tomorrow in terms of market. So it's really designing that portfolio that's built to weather the storm, as they say. And so today I'll pass it over to Matt. He and Karen can give you some more insight, but we'll cover the first quarter, what happened with equities, fixed income. What are some of the questions we're getting from our clients? Whether, is volatility normal? Are we expecting to see more of what happened in 2018 and 2019? Because we've had a pretty good quarter, and I'll let them talk about it. I don't want to steal Matt's thunder, but really, what do we expect to see for the rest of the year? And then we'll take some questions from you. So please take advantage of the opportunity to ask us questions.
Okay, welcome everybody. Again, my name is Matt Sainholtz. I'm Chief Investment Officer here at Tobias Financial Advisors. And what a difference a quarter makes. While we were sitting here presenting our quarterly webinar at the middle of January 2019, just 3 short months ago, we were presenting some pretty red numbers on the screen. The S&P 500 came off a quarter, the fourth quarter, where it was down about 13.5% in the last quarter of 2018. Contrast that to what we're looking at today. What a difference a quarter makes. the U.S. stock market, as measured by the S&P 500, was up about 14%. International emerging markets, 10% approximately, and even the U.S. bond market was up almost 3% in this first quarter. So it's been a combination of events that has spurred the markets to come back and really show significant upward progress in the returns. And we'll touch on a few of these concepts as we move forward, but I think the two or three biggest ones was the Federal Reserve coming out in early January saying they may not be raising interest rates so fast here in 2019. The government shutdown, which was a tough period that we had to go through in our nation, but that was kind of tied up relatively quickly. And the third one is kind of still in the news, but trade tariffs and making trade pacts with China, which is one of the biggest economies in the world. So those kind of three major themes helped this first quarter. Some of those fears weakened, and then we had some opportunity to move forward in the markets.
And if I may just add a little point here, Matt, because I know going into year end, we had a lot of calls, and our job, and I always say our job is to really help clients manage their emotions, because when things are doing well, then it's all well, right? But the hardest part for us as investors is staying the course when things don't appear to be going as well, and it's focusing on that long-term result. And this is an example of that, where if you allow that moment to drive your investment decision, you could really lose out on the opportunity for this market upturn. So this is something that we try to hone in and really help our clients understand, this idea of removing the emotional component of investing. Emotions do not have a place in long-term planning.
It's a great point, Nella. Moving forward, I'll have Karen kind of talk through some of the underlying country returns that compose the U.S. and international returns more broadly. You see here different countries with various return structures. So, Karen, if you could just add some color or just kind of review this returns over the first quarter at the various country level.
Sure. So we saw positive equity market returns, as you mentioned earlier, and these returns were widespread when you look at the country level. In the diagram, you can see that all of the developed markets and most of the emerging markets posted positive returns in the first quarter. You do see a spread in returns from the highest to lowest performing country, and that's not unusual for us to see, particularly for emerging markets, the spread in returns. At Dimensional, our belief is that there are benefits to diversification, including diversifying across countries to capture the broad market returns, the global opportunity set. And we think this is a good way to control for volatility that we see at the country level and spread out country level risk. And also, our research shows that one of the more robust ways to capture the premiums that we focus on in the market, and we'll talk a little bit more about value premiums, small cap premiums, profitability, is in a diversified portfolio, including global diversification.
Yes, absolutely, and we agree with that sentiment, where it is a global economy and it's a global marketplace, so we need to be invested amongst all the country and all the economies throughout the globe that contribute to what is now really a global economy. Taking a step next into the fixed income world, which are bonds. This is where you are, as a bond holder, you're basically lending money to whether a country or a corporation, and then of course you get back an interest rate in return. At the end of the premium, you get your principal back. So, what happened in the first quarter was, I mentioned earlier, Federal Chairman Powell came out basically the first week of January and said, let's slow down. We're going to kind of take a tempered pace with deciding if we're going to continue to raise interest rates in 2019 like they had been raising interest rates in 2018. And that kind of set the tone for what the market perceived, what the Fed was going to do, so what the interest rate structure was going to look like. If you can see the blue line, which is, and the green line below it on our chart here, this is interest rates over different various time periods, from 1 year, very short-term time period, all the way out to 30 years. This is effectively pretty much a flat interest rate environment, a yield curve, we call it a yield curve, where the interest rates line up like this, where it's a flat yield curve. Typically, if you're going to lend somebody money for 30 years, you want more return than if you're going to lend it to them for a year. The way the interest rate structure is today, we are seeing a kind of a not that big of a trade-off between lending somebody money in the 5-year period versus the 30-year period. So what happened in the first quarter of 2019 when the Fed said, okay, we're thinking about lowering or keeping rates the same, and let's see what happens before we make them higher, we saw that green line. We actually saw interest rates lower during the first quarter because now this anticipation from the Fed of not raising interest rates crept in and was priced into the market. So when interest rates went lower, the bonds that you were holding are worth more now because you have a higher bond yield. And so we saw that in the first quarter, which attributed to the fixed income returns that we saw, typically 2 to 3% returns, depending on which area of the bond market you were looking at. And so, that was also added to overall positive portfolio returns when we're talking about a balanced portfolio. That's the review of what happened in the first quarter of 2019. I'll save some comments for the end about kind of what might happen going forward to the interest rate structure, and we'll talk more about that later on. But that was the review of what occurred during the first quarter.
Matt, did we, maybe we're going to talk about it later in terms of the inverted yield curve, because I know that came up. Is that, maybe you'll touch on that in a little bit, or Karen want to touch on that? Because I know we had some kind of panicked clients.
Yeah, but sure, I'll touch on that now. So an inverted yield curve is when the long rates, say the 30-year rates, are actually lower than a 2 or a 5-year rate structure. And that's not that common to be seen in the financial markets. So when that does occur, it will almost occur depending on what term structures you're looking at during the first quarter. It was really close to happening. And sometimes that signals that there may be some slowdown coming in the economy in the next 6 to 12 months. And we really want to see that happen for a persistent amount of time before we really read into that data to see if an inverted yield curve really means that something, maybe a recession, is going to happen down the line. It could be pretty mild. We're not. That's the thing. It might. There was a lot of talk. Oh no, inverted yield curve. It could mean recession. But then where do you? What type of recession do you have? How deep a recession is it going to be? Is it pretty mild? Is it going to be a little bit slower growth, and then the world economy is going to turn right back around? The market prices these things very quickly. And kind of going back to Nella's comments, it's very hard to time interest rate moves, and that's why we want to build a diversified portfolio that we're going to stick with throughout the ups and downs of the market twists and turns.
Perfect. And that was pretty much the conversations we had with our clients, is that it was too soon to tell, and we don't react to that type of, hype.
Thanks. So a couple, what are clients asking? These are questions that we're getting from clients on a regular basis, or things that are interesting to speak about. So, we pretty much saw a V shape in the fourth quarter equity market returns versus the first quarter market returns. I mean, straight down, straight up, or so it feels. And is that normal? And remember, in 2018, we had a lot of days where we saw 2% moves into the different markets. So let's take a look at that. Let's take a deeper dive into how we're defining volatility, what that means. And is it abnormal? Are we kind of seeing abnormal returns and volatility right now, or not? So volatility, as described in this chart, is a single-day stock market move of plus or minus 2%. And I hesitate to say this because I don't like when people kind of follow the Dow when it's at 25,000, and there's a 250-point move in the Dow, or a 500-point move in the Dow. Well, 1 or 2% moves on average are, almost common. 1% surely, 2% you'll see here, where plus or minus 2% trading days. You saw in 2017 we had 310 days without a 2% trading day. over the course of November 16 to let's say February 2018. So 2017 we actually saw zero. So 2018 we then went to this period of, yes, there was more volatility, and so that's a plus or minus 2%, 20 times in 2018, where the average amount of plus or minus 2% days was actually 11 days. 11 days. That's the average since 1950. So how are we doing for 2019 so far? Well, we've only had 2 days where the S&P 500, the U.S. stock market barometer, has been up or down 2%. So if we extrapolate that for the whole course of 2019, that's about 8 days of plus or minus 2% if we continue on the same type of trajectory. So right now we're probably on pace with slightly below average, or maybe probably an average year of volatility. And it's normal. It's normal to see those types of moves, whether it's a news event or any sort of event that's happening in the geopolitical world. You might get a move like this, but we're long-term investors. We want to be able to stomach the ups and downs. And we're going to let Karen take this one, and I'll pose the question to Karen. Karen, we have clients that might have just inherited money, or maybe they just retired, or they came into some money and kind of in a lump sum fashion. And the question is, well, the markets are up so high. Is this a good time to be investing? I mean, maybe I want to put it under the mattress for a year or two before so the market comes down, and I know I can get in at a better price. So it's tough to do that. We know that, but we'd love to hear your thoughts about investing when the market seems to be making newer highs on a somewhat regular basis.
Yeah, absolutely. It's not unusual, especially after a quarter of strong positive returns like we just saw, for clients to ask that question. Should I invest at what seems to be a market peak, or would it be better just to wait a little while, see if the market maybe pulls back a little bit and find the right time to enter the equity market? And it's a normal instinct to wonder about that. One way to answer it is just to look at lots and lots of historical data and say, well, we've got data on stock markets and how it's performed and subsequent returns if you go all the way back to 1926. So what if you took a look at all the periods of time going back in history and identified market peaks, and then said, well, if you look at equity markets from that point forward, what did you see on average for the subsequent periods? So the subsequent, in this chart, 1 year look ahead period, subsequent 3 years on average, and subsequent 5 years on average. And what you see is basically positive equity market returns. On average, typical U.S. stock market returns have been about 10%. So you see especially when you start getting out to an average 3-year return and 5-year returns, basically returns close to normal if you took a look at all these observations of periods of times when you saw market peaks. And, interestingly, we also have a diagram that looks at the opposite case. What about market declines? And there, I think the instinct's a little bit different, maybe more of a fear and wanting to get out of the markets and wait for things to get back to normal, feeling of confidence. And you see very similar numbers. So if you look at the 1 year look ahead, 3-year look ahead, and 5-year look ahead after what you'd identify as market declines, for example, in the study we did, we looked at when the market was down over a period of time of 10% or more. You see very similar numbers whether you look at market peaks or declines. So while I think the instincts are really easy to understand in both of those cases, there's really no evidence when you look at lots of empirical data that those give you a signal, kind of a robust or strong signal about what you should do or when you should invest. And rather,
Absolutely.
I think we argue, again, for this long-term focus, deciding if equity markets in your portfolio is appropriate for you, and then to withstand that volatility by really trying to kind of hold your discipline to earn those returns when they appear.
Yeah, that's a great point. I mean, when we develop a portfolio, we're not just putting all the eggs in one basket. We're not just going all into the equity market. We use the fixed income basket, or fixed income allocation, as a diversifier. And if for some reason you do invest right away and you've unfortunately experienced a market downturn right away, well, we have some ammo on the sidelines in the form of fixed income that we could sell and then buy into the weakness. So it goes back to timing the markets, a difficult thing to accomplish over the long term.
Excellent. And one other question, just to jump on another question that we usually get, and these days, a little bit more frequently than other times is, should I invest in growth versus value stock? And so maybe Karen, you can maybe offer a little insight on growth versus value and what your thoughts on where clients should be looking to invest.
Sure. So Dimensional, we've long been value investors. So we design our portfolios to cover a certain asset class on the equity side, and then we seek premiums over the market return through focusing on companies with a combination of value characteristics, smaller cap companies, and then another element would be higher profitability companies. Those three are what we've identified as dimensions of equity returns in markets around the world. And there's lots of evidence, if you look at the long-term data, going back in time and then across different markets, that these premiums around size, value, and higher profitability companies have been persistent and have been pervasive over time. However, like the equity market itself, over shorter periods of time, just like you can see equity markets outperform in the long term compared to T-bills, but perhaps have negative returns over shorter periods, you can see the same sort of volatility around size, value, and the one not shown here, which is profitability. So focusing on what happened in the first quarter of the year, if you go back a page or back a slide, you can see that generally speaking, it's a mix, as it would be over any particular quarter. We did see small cap stocks have strong positive performance in the U.S. and developed markets after a period of some negative returns in the fourth quarter of 2018. Value depends on where you look, but in general, if you look at broad market indices across these different regions, growth generally outperformed value. So you see some underperformance of value here. We've also seen value in particular have headwinds on and off for the last few years. So we often get a question about value investing in general. It's something we've seen before. We think that value premiums are supported by lots of data and good, sensible theoretical underpinnings. So we believe in it for the long run. So one of the questions we sometimes get is, well, how long do you have to hang on to see these premiums? No, there's no kind of sure answer. Investing in equities in general, there's no guarantees. But what we can do, again, is go back to the historical data and say, if we look at all the evidence that we have, if you go back over periods of time, what would your likelihood have been of realizing size or value or profitability premiums over different time periods? And that's what the next slide shows. So moving kind of from this quarterly information to longer term on the next slide. And
Karen?
here we're focused. Yes. Mm-hmm.
Just real quick, I was, as before you dive into the more historical numbers, if you could just kind of take us back to step one and kind of just talk to us a little bit about what is value versus growth, and let's just bring it back to a little bit of the building blocks of why, what that means.
What's different? Yeah. What's the difference between growth versus value, and how should an investor think of those two?
Mm-hmm.
Absolutely. Yeah, because value just colloquially means a lot of different things to different people. And when we talk about value stocks, we're talking about companies that are lower price companies. So if you rank companies in the same market and you use a metric that compares price to some fundamentals, so one of the main metrics we use would be companies that are low price compared to their book value, for example. Companies with the lowest prices are considered value companies, and companies with relatively high prices are considered growth companies. So really the underlying theory basically says that expected returns are driven by the price that you pay and the cash flow you expect to receive, and that historically on average you've seen that if you lean toward or emphasize lower price companies and you also kind of build in that component, pair it with higher profitability or higher expected cash flows, that these types of companies have had persistently higher returns over time, depending, and really no matter whether you look at the U.S. developed markets or emerging markets. But then you see these fluctuations over different time periods. So we have lots of ways of showing the data over really many different time periods, but this is one that we find that's been of interest, which basically says if you look back over time, and you can see these lengthy time periods shown for the U.S. developed markets and emerging, and we focus on value stocks, these low-price companies compared to high-price companies in the U.S. market, where we really have the most data and the most observations. What would have been the likelihood of realizing a positive premium, meaning that value beat growth over 1 year, over 5 years, over 10-year periods of time? And what you can see is that the longer you hold your discipline, again, this theme of discipline applied to the equity markets also applies to premiums like value, the higher the likelihood of achieving a positive premium, although it never goes to 100%. So markets are risky, premiums are risky, but you do increase your likelihood of getting this outperformance the longer that you are able to kind of stick with it, is basically the theme that you show here. And we also, when we're forming portfolios, we say, okay, knowing that there'll be periods of underperformance and outperformance, what can we do? I mean, certainly one is to kind of hold our discipline in our portfolios and have this long-term focus. But what are some other things we can do? Well, we've researched whether this is predictable. Can you predict whether value will outperform growth or growth outperform value in the next period? And there's many different common ways that people think about predicting it. And basically, without getting into all that research, the upshot's been that it's very difficult to predict. Markets move rapidly, as we've seen. They can have quick inversions. There's a lot of volatility, which makes it difficult to really have a robust way of market timing. Again, that theme we hear over and over again. Another thing we can do is to be diversified, to integrate the different premiums in the same portfolio so that they tend to outperform at different times. You kind of capture that diversification. And also, again, this theme of diversifying regionally. If you have a global portfolio, diversifying across stocks and across sectors, we've shown has allowed us to kind of keep this portfolio focused on the premiums we want, but to kind of smooth out the ride along the way. So those are some things that we think about and consider in our portfolios when we're applying this belief set.
Thanks, Karen. That kind of leads right into our next question here. You know, you have had a great career and a fellow chartered financial analyst, and I really appreciate you taking the time to be with us today. And you've kind of thought long and hard over your career about what's the best way for investors to achieve their goals by, you know, maximizing return, but taking prudent levels of risk. And, you know, so if you could just talk to us about, you know, what are the benefits of diversification, and on top of that, just maybe things to think about for long-term investors. You feel free to add in anything that you might want to relay to our audience that might be good for someone who is thinking about retirement and making their money last another 30, 40 years.
Sure. So kind of getting into what are the benefits of diversification, there are many ways to think about diversification. You know, I think really one of the critical ones is diversifying across asset classes, which is one of the things that this particular slide addresses. How much equity exposure do you want to take versus blending it in with, in this case, T-bills to kind of dampen out some of that volatility. So I'll talk about that in just a moment, because that's, you know, obviously very central and crucial in terms of the decision to make. Others, again, are diversifying globally. We brought that up a few times. It's always an interesting conversation, especially when you go through a period of time when the U.S. equity market has had good returns, solid returns, and outperforming in certain years international markets and emerging markets. You know, it makes investors kind of question why go outside the U.S. So because we'll show a global equity portfolio on this slide, I'll talk a little bit about that. I think a nice place to think of for equity portfolios as a starting point is the whole world opportunity set as your starting point. So thinking about the world market cap and market cap weight. So what does the global marketplace really kind of offer in terms of an investable universe? And if you look at that, the U.S. typically represents about half the world marketplace, and about, you know, it ebbs and flows, but around 50% on average, whereas the other half is companies that are listed in developed markets and emerging markets outside the U.S. So if you were to exclude those markets altogether, it's a pretty big exclusion, pretty big departure from that total opportunity set. Also, if you go further back in time, historically, if you go all the way back over this longer kind of investment time frame, there are periods of time where the U.S. equity market outperforms international. There are periods of time when the reverse is true. You'll see some of that in in the next slide that comes after this one. But it's hard to know in advance, again, which one it'll be. So that diversification really helps you spread out your investment so that when lightning strikes and it hits one particular region, you're going to capture that somewhere in your portfolio. So that's global diversification. In this particular chart, what you're looking at is a globally diversified stock portfolio and then some different mixes. So if you look at the top right-hand corner, you're starting out with 100% stocks, and this is based on MSCI's equity index, so the global benchmark covering all the world markets. And then you get different mix, 75% stocks, 25% T-bills, all the way down to the bottom, which is 100% T-bills. So looking over the past period of time, couple of decades since we have that data, if you have 100% stocks, you get the highest return, and you also see that with the growth of wealth. And this is a global portfolio incorporating all of those markets. It's never a free lunch. Looking at the bottom left-hand corner, you get those higher returns the more you have stocks in the portfolio, but that's, of course, hand in hand with higher standard deviation. So that number on the right-hand side of standard deviation is highest for 100% stocks and lowest for T-bills. Standard deviation reflecting how many ups and downs you'll have in your portfolio. And you can see it in the growth of the wealth line. That 100% stock portfolio winds up at the top of the list, but you see those big dips along the way. If investors, in order to capture that return, that full growth of wealth, you have to hang in there. If you were to exit at one of those dips, you won't capture that number that you see over the long-term horizon. So again, the importance of really being able to have a portfolio that works, that you can stick with over the long run, is illustrated by what we see here.
And Karen, I love this. I love the way, you illustrated that, because we often talk to clients about what return, there's appetite for risk and then there's need for risk. So talking about kind of long-term goals is we wouldn't want to take more risk than we absolutely have to, right? I mean, why, if it's going to make you nervous, keep you up at night, I mean, that's one of the things that we help manage, is kind of looking at how much return do you need to meet all your goals, and if we don't have to take on more risk, because as you pointed out, 100% stock portfolio, they're looking at pretty big swings up and down.
Absolutely. And, keeping on that topic of diversification, and if you've been into our presentations before, this is one of our favorite slides here. I call it the quilt chart because I feel like it's a kind of a patchwork of quilts. And we basically, what we're looking at here is across the top is the year, and then below it is a column of ranked returns. So each color represents an asset class that you could invest in, and I'll just choose one, which is green. Back in 2004, large cap, the green was a 10.9% return. And if you look across to the right, you'll see that the green is up and it's down, and it's below the line that is drawn through the whole chart and above the line that's drawn through the whole chart. That's pretty much the S&P 500. That's U.S. stocks. And as you can see in 2018, if we want to revisit that dreadful year, that was that column there. We have cash on top, and everything else was pretty much below cash. And the last time that happened is not even on this chart. It's dated back into about 30 or 40 years ago, the last time cash was on top of the asset class chart like this. But, just to drive the point home, we had a really good quarter on the quarter-to-date numbers, the year-to-date there, U.S. markets, and basically everything was positive. And cash, kind of what Karen was saying, there's no free lunch, and if you're in all cash, you're generally going to be at the bottom of the list on a regular basis over the long term. And so this chart kind of just shows that market timing and trying to get into small caps, which is the orange chart or patch here represented, is hard to do. Many years it's below the asset allocation line drawn through this chart, which is kind of a balanced portfolio, which we tend to believe in and really stick by as our virtues as long-term investors, is that we're going to diversify the portfolio across all these long-term and different types of asset classes. And so, did you have anything to add on that?
No, I mean, I this is my favorite chart, because it just really highlights that, there's not any one asset class that is going to be, we can't predict. We don't know which one is going to be in the top, which one is going to make its worst year. So this is a really good reminder of why we have to be diversified, not only globally, but across all the different asset classes.
Absolutely. So, what to expect going forward? There's different things happening throughout the world. One being, of course, trade talks. It's probably going to stay with us probably through, realistically, up through the 2020 election. Whether you like the politics or not, these election cycles really start earlier and earlier every 4 years, and this is no exception this year. So we're starting to see the field of Democrats come to the fruition and come to the top here, and see. We'll have more of a view of that this summer. But I think too, the trade talks are going to be a prominent factor here throughout the next year and a half. But hopefully, we do see some continued fair trade agreed between different economies through the world. I mean, that's how we all lift basic economics. Economics 101 is, if it's free trade and we do something better than another country, let's trade and help each other out. And so that will be a prevalent theme throughout the year. And I think that's also starting to see that, there has been talk in the first quarter. I mentioned earlier that there could be some potentially good trade deals between U.S. and China. And we have been seeing other charts and other data come out recently that China had a good growth in the last couple weeks. And we're starting to see kind of in 2017, some of the manufacturing data kind of come down and decrease when you're looking at manufacturing data throughout the globe. And most recently, those numbers are starting to level off and maybe even starting to tick up a little bit. So we might be seeing some more global growth, which plays into our idea of diversifying your portfolio internationally and having exposures all across the globe. In the U.S. and equities, we've had a great start. So we're up 14 in the U.S. It was in the first quarter there, we're up 13-14%, and so we hopefully will continue to see this positive results. Now, we're going to be monitoring the portfolio and rebalancing our clients' portfolios when the opportunity presents itself. But we're starting to see some of the earnings are coming out for the first quarter, so we're monitoring some of those and reviewing some of those earnings announcements to see what companies are thinking, and of course our mutual fund managers are doing their best to deliver a portfolio that is not only diversified but low cost and works for our needs. Bond yields, I mentioned earlier. Yeah, this is a push-pull that you're seeing in the headlines within the United States Federal Reserve, but also globally. We're seeing the ECB thinking about doing different measures to keeping their rates low and to spur their economies, and that's in the Eurozone, and other countries abroad are kind of keeping their rates low, and now the U.S., of course, as I mentioned earlier, has come out and said, well, maybe now we're not going to raise rates as fast. So right now we're in a kind of a wait-and-see period. I think that's what the Fed is looking to see which data is going to come out, and if the economy is feeling a little bit weaker and in the eyes of the Federal Reserve, then maybe they will pause. And we have some bond managers out there saying we're seeing interest rate cut this year. It's just something that it's too early to tell. The data's got to come back and kind of see where we're headed for 2019. And finally, the U.S. economy, we're still growing. I mean, there's a lot of talk out there. We get the market's high. They can't be sustainable. This economy can't maintain itself. But look, the unemployment rate, hearing anecdotally, college graduates coming out of school this spring or might have an easier time finding a job. Mm-hmm. You're hearing that the economic and the unemployment numbers are still tight. So I think there doesn't seem to be a recession on the immediate horizon here in 2019. So I feel like we're going to continue to have solid, we wish it was faster, I always wish it is, but solid growth here in the United States when the GDP numbers come out. And that's why we want to stay invested. So we're going to have Karen kind of give us any final thoughts that she might have, and kind of talk to us about whatever she might want to add into our conversation here.
Yeah, sure. I think in closing, I would just recap some of the themes I spoke about earlier in the presentation. When we talk about events that take place during a quarter, we talk about market movements during a given quarter or a given year, it's useful to keep in mind this idea that volatility is part of investing, especially when you're dealing with equities and equity markets around the world. And we have a lot of information on how stock markets have behaved historically. What we've seen is that investors are able to keep their discipline during these periods of volatility and continue to maintain their long-term allocations, have been rewarded for doing that. So some of the things that we think help keep this focus would be a well-diversified portfolio, well-diversified in terms of across asset classes, globally, across stock sectors, different markets, as well as, an asset allocation that fits the investor's goals and risk tolerances. And these things are important because having an investment strategy that you can stick with is something that helps weather the markets, which we found is something that then leads to some of the best results for clients, investors, for their portfolios.
Absolutely. We've seen it in the past where people let their emotions get the best of them and they make decisions that may or may not be in their best interest over the long term. And so we've seen it, and we try to counsel our clients against that, and we really believe that having the broad-based approach and knowing your time horizon, knowing what this money is meant for you, your own personal situation, is the utmost importance, and how we're going to invest that money. And so we have to really define what the goals are, the time horizon to invest in order to meet our goals and to accomplish everything that we and our clients like to do. I mean, our job here is to help clients live the lives that they want, and we really believe that having the portfolio situated in the correct manner is one tool to get them there, but also the other planning techniques and planning tools that we use throughout the year, whether it's taxes or estate planning, to help deliver an optimal solution for our clients.
Yes, exactly. I mean, I echo everything you just said. Our job is to really be here as a coach and really, help our clients think through and help them focus on that long-term plan. And the portfolio is just one of the tools that's going to help us achieve those long-term plans. So we always want to remember that long game and not trying to react to headlines or just kind of the moment. So that's kind of our focus when we look at portfolios. And Karen, I want to thank you so much for spending this hour with us and offering all your insight. I think that was very helpful to just kind of get that outside perspective on how we see portfolios and the importance of diversification and especially global diversification. So thank you so much for spending time with us. It looks like we did such a great job, Karen, that we actually don't have any questions. So if any clients have follow-up questions, please feel free to reach out. Again, thank you everyone for spending your lunch hour with us, and we wish everyone a great afternoon. And that's all. So
Yes. Thanks, Karen. Goodbye, everybody.
Bye.
Thank you.